Traders, Mark here from Flipside Trading, and it is Sunday afternoon, August 30th. Can you believe that? August is one more trading day for the month is over, and we move into September. Unbelievable. All right, so what are we going to talk about? Glad you're here. Let's get educated. Let's talk about what happened with the Fed and kind of what the ramifications may be on their decision to kind of inflate our debt away. We'll talk about the market in general. Again, we're kind of neutral to bullish. We've also been posting some trades on Twitter and some earnings trades. We definitely want to talk about how to defend an earnings trade here. We'll talk about the new economy and, of course, the trade of the week and something a little different today, the transport. So let's dive right in and see what we got. So let's go to the charts. And let's start with the SPX. So as we talked about last week, we saw this consolidation that was happening, right here. And basically, I was kind of surprised. I thought we would continue to grind, but you can see what we did is we actually gapped up. When you gap up from a break of consolidation, that means the market is going to run, or usually it's going to mean a high probability. And that's exactly what we did. And you can kind of see here that we went all the way up to our 100% mark, at the doji, which is right up to here. And maybe we can get a better look at that. Sometimes these screen draw tools the menu's not as good. So that matches basically this, what we're looking at. But what we're coming to here is this trend line, and this is a big megaphone trend line. I'm going to actually move out a little bit to the weekly so you get a better idea of how long and consistent or persistent that this trend line can be. So I'm going to even scrunch this down a little bit further. And you can see that this goes all the way back to, basically October 12th. And we're coming right up, to it. We have a little bit of room left. And I think that, that's going to be like a key decision point. So be careful if you're adding new longs here. Definitely, I would think about, trailing some stops and or taking some profits, given where we're at. So in that same vein, if we look at the NASDAQ, you can see that they're even more up against the last channel. And you can see that here, really tight. This is a really, really steep channel. We'll drop this back down to the dailies as well. And what I would expect to see at this juncture, more than likely, is as the NASDAQ makes its decision of what it's going to do here, right? It broke through the 100%, right? Same thing that we talked about before in the overall symmetry, right? We're looking at this and then projecting that here. But we're right here at the 127 extension, right here, at this overall trend line. As the market figure out, the NDX at least figures out what it wants to do, right? It can bust forward, it can move sideways, it can drop. I have no idea of saying, but while it's contemplating, I wouldn't, I would expect to see kind of the market continue kind of a rotation, maybe, out of NDX and into some of the lower performing stocks, right? Some of the non-new economy stuff, your key economy pieces, your industrials, your transports, moving up. Because what Powell said is that, look, there's two ways to get rid of debt, right? If we have so much debt, and I think we're now about 130% of GDP, you can start having defaults, which we don't want to do because then that just curtails the economy, or you can start inflating. And if you keep inflating and printing money, which was basically what Powell said, is that it will allow us to get a more footing on recovery. But when inflation hits, it's going to be a nightmare. Now, when that inflation hits, it's probably a couple of years away. It's something we'll definitely keep an eye on. But, at this point, I think that we'll kind of see that rotation. Now, given that as well, if you also take a look at what is really happening even in the small caps, and let's get rid of these drawings here, and we go to the RUT. The RUT is still trailing. It's still grinding and moving higher. But one of the big reasons is that, when you look at defaults have doubled for companies over $50 million, and they've tripled for companies, over $5 million. So what's happening is that the credit even though we have liquidity in the market by the Fed printing all this money, that money is only going to basically your mid to large caps. It's not finding its way down to small caps in general. And that's why I think that you're not seeing the small caps participate here, because there's not the dollars to actually, everyone's floating bonds at this standpoint, and they can't float bonds in order to make that happen to kind of bridge the uncertainty gap. And because we're floating bonds, and we'll take a look at the 10-year Treasury yield, and we'll kind of bring that back a little bit. And you can see how low it is, right? This is the, no one can find yield here, so they're looking to, basically corporate bonds and some high yield bonds, right? If you look at high yield bonds, they are not really moving up too much because this is where your small caps are, right? So your corporate bonds, people are buying, that's your IEF. And if they're not buying those and they're looking for yield, well, what are they doing? That bond money is coming to the stock market. And if I could type, we'd be in good shape. And that's what's pushing the market up, okay? That's kind of the driving factor, that we have. So I really think that, in general, we're, that neutral to bullish. We have to watch those trend lines. I expect to see, like I said, a little bit of rotation, and that's why our trade of the week will be in transports, as well as the technical pieces as we go forward. Now, one of the key things I wanted to talk about is earnings trades. So I'm going to go ahead and kind of load some stuff up here first, and then kind of move back, because it's going to take a while to actually show you what I want to see on a more, should we say, granular level. So basically, I'll show you out on Twitter that on August 25th, I said, okay, we're going to go ahead and, we have a pretty good run up here in CRM. We gapped up based upon their news. And the news here was that they were going to include CRM into the Dow Industrials, right? Getting rid of Exxon. And so that's a pretty interesting shift from kind of the old economy to the new economy. And it really seemed kind of like we were a little bit of exasperated, extended here, and kind of losing, our position. So I was like, okay, here is, 230, more than one standard deviation. So the idea was we were going to put on a 230, 235, call a credit spread and take in 50 cents. So a lot of times that when people talk about these types of trades, they say that they're binary, and to an extent they are, but you can defend them, and you have to decide when and where to defend them. And I'll show you how we did that in a second, and we'll also talk about why in a moment. So what I'm going to do is I'm going to go down here to a 2-minute time frame, and let's see, our time frame here is what happened. Let's go. There we go. Let's go to 5 minute, and then we'll kind of kick that down to the 2 minute, and we'll go from here. And why isn't it let me get down any lower than that? Hold on a second. Okay, we're back. Sorry about that. As usual, Thinkorswim is being finicky. But as you can see here back in the Twitter sphere, that we actually posted a trade idea on CRM. It's what we talked about, this 230, 235, for the reasons that we mentioned. But also note that we did say here that there's always the risk of the perfect earnings report, right? And if so, it can go 2 standard deviations or higher. I talk about a self-fulfilling prophecy. Well, it definitely happened. And what we did is we said, okay, you can defend it. You don't have to wait till tomorrow. There is an after hours market. And so what we did is basically retweeted and said, hey, look, we're going to buy the stock at 226. We bought 50 shares in order to defend that credit spread. And at that point in time, CRM was still moving up at 231. So this is one of the plans that we had in place of how we defend it. And we said, okay, I'll show you why it was 226 here in a second. So if we go back to CRM, and we're on a 2-minute time frame now, I'm going to go back. We're going to look at after hours. I'm going to get this to August 25th. Okay. So right here on August 25th, they had good earnings. You can see they had this, big jump. It was moving upwards and onwards. And so, but basically right here at this line, right? I said if we begin to cross this, I'm going to put an order in to buy stock at 226. And the idea is I bought 50 shares and, in order to defend. And unfortunately we did, because we had a 230 short strike, right, which is right about here. And, even in the after hours market, it kept going. So the key thing is, guys, you can buy stocks, in the aftermarket in order to defend your credit spread. Not only to defending if it's going against you, but also to lock in profits. And to lock in profits, I'll show you an example of that in a minute, like with Vive, is that you need to sell stock as well. So the key thing is that you can see as we move forward, and I'll kind of keep this here and show you where I took profit. So the next day we opened up and moved up, we're moving up, and we got right here. And when I saw this exhaustion and kind of failed, push back, basically, I sold kind of in this 255, 256 area, right here. Now, I also calculated out that with my 50 shares, look at my P&L, is that, since number one, I was over, we were over based on the open, right, on my short strike of 230, right, we're messing around up here at, at 250, is I got out, and I got out for a loss, and let's show you, I can show you what that looks like here in a second. So basically, and here's kind of, we bought it, right? We bought the 226, and it was a lot of work, right? But we reserved capital. That's what it's all about, right? It's having a plan before we jump into it. We made some lunch money because we sold the 50 shares that we bought after market for 256 that yielded a profit of about 1580, and our loss is about 1340. So yeah, it was a lot of work. Did I make a lot of money? No. Did it go higher? Yeah, it went all the way up to 260, 270. But that at that point in time, that was not where my mind was. Maybe it should have been. But basically, I was looking to preserve capital and get out break evens, a little bit better break even. So we did that. We got out basically, like I said, at that exhaustion spike, and we were good to go. But like I said, if you have a call spread on, and you think, for example, for Vive, and you think that the earnings are going to go up, and you did something like that, and so if you open and move all the way up, and you can see that you basically closed down here, is that you can actually sell stock in order to preserve some of your profits, right? You can still leave the call spread on. You look at your deltas, right? You're trading, say if you had 3 contracts, that's 300 shares. Maybe you sell 50 shares. Maybe you sell about between 50 and 100 shares in order to lock that profit in, and now you have a runner. So if you're going to trade any types of earnings trades, you definitely have to be able to feel comfortable with buying stock or selling stock in the aftermarket in order to manage these trades and not make them as binary as they would appear. Because if I didn't buy any stock, then I was basically out that $1,300 no matter what. But because you're playing the market, in the aftermarket and kind of the before market, you can do something to keep that trade alive and preserve your capital. All right. So now let's take a look at, we talked about the new economy, and this kind of also gives me some signals of what's happening. If we take a look at our new economy, our ETFs, and we look at it from a weekly standpoint, let's get us there, 1 week. And you can see that, again, here's the S&P 500, right here. We're kind of about split. We probably did a little bit better. The key is this tan is just cranking, this solar. Software is still doing well. The software pieces did well. Technology, did well. Your payments did well. But you can kind of see that we're, semiconductors are taking a little back seat. Your health, XLV is taking a little seat. Your IBBs and kind of your biotechs are starting to, come back. Your XBI, all those things are kind of getting a little bit of a rotation out, or at least kind of a wait and see. And so, I kind of took a look at this, and If you look at just the S&P 500 sectors, let's see, again over a same week time frame, you can see communications did really well, technology well, finance kicked up a little bit, but your building materials and basically your industrials, started to move. Some of your customer discretionary, and then your consumers, right? But you can see that things may be slowing down a little bit and coming back to, where we're going. So again, given that we're, at those key, should we say, trend lines for the SPX and the NDX, I thought that transports look good, and the reason is, and let's go to the transports here, and I'll take a look at why. One, we're seeing kind of a rotation, but technically, what does that mean to us? And let's let Thinkorswim think a bit. What you'll see is that we had this VPOC here, which defined an overall, basically, consolidation area, and we popped out of it, and then we bounced down and retested, and we started moving up. Now, as we start moving up, we have another VPOC right here, right at this level, and that level is pulled down a little bit. It's kind of that 207. So if we open higher on Monday and basically put a stop, a 2-day trailing stop down here around 197, we're really looking for this kind of confluence of resistance / target, right? The VPOC starts to act like a magnet, because that's where this security was traded before, and it found equilibrium in the overall auction process. It also kind of lines up with the 618 retracement of basically this last push we had from symmetry from here to here. So I think overall, if we kind of look at this, that this is a really good target area, and it also matches up here. So my first target would be this high right here, which is at hold on, so I moved it a little bit. Let's see, that high around 203. I would definitely at least move my stop to break even if I didn't take profits there, and I would really look for kind of a 207 target on that piece. So that's what I have this week for trade of the week. I also want to go back and take a look at our trade of the week last week, which was MDB. Now remember, MDB has earnings on September the 1st, and this was a play into earnings, right? We're hoping that we get the rise. If we broke basically the POC, right? That's what we talked about here. That POC was at 221, and we got into it, and our first target really was looking for us to close the gap, which was right here. And I wish it would come the other way. So we closed the gap right there. That was our first target, right? It was before we hit the top of this value area. You can see that we've tried to get out of there twice, and we haven't. And so once we hit this and kind of move back, we put our stop just above break even, right here at 222. So at this juncture, I'm willing to let this ride another day or two to see if we get a pop out of earnings, even though we just got one target. But at least we're going to be a little bit above break even. And if we do, I would ride it probably to the 1st of September and maybe into the morning of the 2nd to take advantage of, you say, new money coming in from basically all the 401ks and IRAs as that money transfers to the beginning of the month. But again, I would really keep that tight stop on here and manage that one. And I will go back one farther, and we actually did close fully the Adobe trade. And what happened here, we had that call spread on, the 265, 250, 265, and you can see, I'm sorry, way up to, is the 500. So basically we've, pushed all the way through, and it's not worth holding on until September 15th. I mean, we're just not going to get the max. And so once we, pushed and punched, all the way up here, I basically, closed that trade down, at that 520 area, and called it good. So even though the max spread, I think it was 15 wide, I think we got about $10 out of it. It was definitely a double. So right now, the trade of the weeks are working well, but at this point in time, it doesn't make sense to hold all the way on to the 15th. Only bad things could happen at this point in time, so it's just worth taking your money out of the trade. Okay, guys, that's what we got for you. Hope you enjoy it, and we'll talk to you soon. Bye.